What are the key indicators of a potential recession or economic crisis? Recessions, just the word makes people nervous. Markets crash, jobs disappear, businesses close. But what if you could see it coming before it hits? What if you knew what signs to look for, like economic storm clouds gathering on the horizon? In this video, we'll break down the key indicators of a potential recession or economic crisis. Not in boring economics jargon, but in a way that's practical, real, and easy to understand. Let's get into it. 1. The inverted yield curve. First up, one of the most reliable indicators of a coming recession, the inverted yield curve. Normally, long-term bonds pay more interest than short-term ones. But when short-term bonds start offering higher returns, that's a red flag. Why? It means investors don't trust the short-term economy and they're locking money away long-term. Did you know that the yield curve inverted before every US recession in the past 50 years? In 2019, it inverted, and what happened a year later? That's right. COVID triggered a global economic crisis. While the virus was the spark, the warning signs were already blinking red. 2. Rising unemployment. Next is unemployment. When companies anticipate lower revenue, the first thing they often do is cut labor costs. That means layoffs. So rising unemployment claims are a huge red flag. The US unemployment rate jumped from 3.5% to over 14% in just 2 months during 2020. That's the highest since the Great Depression. Did you know? In many past recessions, rising jobless claims were already spiking before GDP started contracting. 3. Slowing GDP growth. Speaking of GDP, gross domestic product, it's the big picture measure of a nation's economic health. When GDP shrinks for 2 quarters in a row, it's officially a recession. But savvy investors don't wait for that label. They watch the trend. If quarterly GDP growth starts declining rapidly, especially with high inflation or weak consumer spending, it's time to get cautious. Did you know that in the 2008 financial crisis, US GDP started declining months before the market crash? The writing was on the wall, but many didn't read it. 4. Consumer confidence and spending. When people feel unsure about the future, they stop spending. The Consumer Confidence Index and retail sales data tell us exactly how optimistic or nervous people are.
Low confidence leads to less spending, slower growth, and eventually a recession.
Did you know that consumer spending makes up about 70% of the US economy, so when consumers panic, the economy follows? 5. Rising corporate debt and defaults. Recessions often expose companies that have been operating on shaky ground. If too many companies have high debt levels and low cash reserves, they default when cash flow tightens. In the lead-up to the 2008 crisis, corporate and mortgage debt hit record levels. When the crash came, defaults spread like wildfire. Did you know that as of 2024, global corporate debt is at an all-time high of over $90 trillion? If interest rates keep rising, some companies won't survive. 6. The stock market isn't the economy. Here's the tricky part. The stock market often rallies while the economy is still struggling. It's not a perfect mirror. The market is driven by expectations, not always reality. That's why it's important to look beyond Wall Street headlines and understand the fundamentals. So here's your recession radar.
Inverted yield curve, rising unemployment, falling GDP, weak consumer confidence, and surging corporate debt.
Watch these indicators, not just the news cycle. Did you know that by understanding these early signals, you can make smarter decisions with your money, protect your investments, and even find opportunities when others panic? If you want more videos like this, clear, fact-based, and actionable, make sure to hit that subscribe button and turn on notifications. Because knowledge isn't just power, it's protection. Thanks for watching. Check out our video on how to build financial freedom even during a recession, linked right here. And remember, recessions are tough, but the prepared always come out stronger.